International Seminar, which is an event that is usually held every 2 years between OPEC and all of its stakeholders in the international oil industry, including the CEOs of many of the world's biggest oil and gas companies, which will be here later this morning. The event kicks off in about an hour. It is on a day, we're told us apparently that there will be a big surprise today. I'm not quite sure what that will be. Is that a lights and camera show, or is that some sort of news announcement? We will wait to see. But oil prices remain stuck on that $75 level, despite the announcement earlier this week that Saudi Arabia and Russia would be extending cuts. Let's welcome our three guests this morning. We got Narendra Taneja, India's leading energy expert, Rachel Siemba, founder of Siemba Insights, an adjunct fellow at the Center for New American Security, and Mark Otswald, chief economist and global strategist at ADM Investor Services International. Let's kick off with Mark this morning. Mark, we're sort of scratching our heads this week as to why Brent crude is stuck on $75 a barrel, regardless of whatever is announced on the supply or the demand side. It would appear we had Energy Aspects do a op-ed to this morning's Financial Times trying to explain the conundrum, and their answer was, well, due to the rise in interest rates, the cost of money has deflated the appetite of traders and storage companies to stockpile oil in case this recession does arrive, and consequently there's a softer pull on oil. Your take this week, Mark, on the conundrum with prices not moving off their $75 mark despite the further cuts announced?
I think the general perspective is coming after all the cuts that we've already had, and given also a certain lack of evidence of compliance by Russia, which undermines the whole drive to try and prop prices up, is this view that OPEC keeps on cutting and doesn't really seem to be having much impact. And so people basically now saying this is just basically yet another defensive move, and will this one work? So I think it's very much the aspect that people are very negative on the global economy. I have to say there is a big disconnect in all of this, and that is that outside of Europe, so that includes the UK, the evidence from America is actually that the survey data is a lot more negative than the real data, which is worth bearing in mind.
Well, that's been kind of the narrative for a while, hasn't it, Mark? I mean, this sort of crying wolf that this great big bad recession is just around the corner, and yet it never arrives. Are we all just getting it wrong, or are we being misled by data?
Well, I think we're being misled by surveys, certainly in the US. In Europe, I think there's a greater justification. The UK is not doing as badly as people have said, but the evidence from countries like Germany and France is certainly not good. There's no doubt about it. And people are above all disappointed by China. And China was the big hope. And I think that's really where the problem lies, that people are looking at the Chinese data, looking particularly, I think, for the second half of the year at the strength of Chinese oil imports during the first half of the year, not seeing the domestic demand, seeing a lot of re-exports, worrying about the fact that China essentially is, yes, importing a lot, but re-exporting a lot of product. And that is really where, and also the fact that we keep on hearing, yes, there's going to be a big stimulus package in China. Where is it? And I think that is one of the big issues for markets.
Well, you wonder if they still have the same bazookas. How much cement and apartment buildings can you build? Rachel, welcome to the podcast this morning. I wanted to get your views, just picking up on China there, because, of course, Janet Yellen, the Treasury Secretary of the United States, is on her way to China, first visit in a while, I think, since she's become Treasury Secretary. Nonetheless, another big drag on the global economy is this big disruption between US and China trade. And we have the Chinese announcing in recent days plans to curtail exports of special metals required in the tech space. Your thoughts on the visit of Janet Yellen to China, and can it break the impasse that currently seems to be bedding in that China and the US are in some kind of divorce?
So I don't think it's going to break the big picture impasse. I think what Janet Yellen is trying to do, what the US is trying to do, and the Treasury Secretary has really been the big face of this in many ways, is to keep talking to the Chinese. So not to have a big rupture, a big bitter, say, divorce, to use your analogy. But this is going to have, we're going to continue to see both the US and China using national security as a justification for more trade restrictions. In many ways, the new export controls, the licensing requirements for gallium and germanium announced earlier this week, I think are China mirroring the US, saying, you don't want to let us buy your top level chips and equipment to make them. We're not going to make it, we may not make it easy for you or the Europeans to innovate and move ahead on building your own electric vehicle or battery technology. So I think we might not see an escalation of tit for tat and maybe stretch to military. But I do think that these sort of bifurcation of certain sensitive industries is going to stay. Now, what's interesting when you look at global trade, of course, is the US, if anything, is still buying more from China than they used to. It's not growing as fast as the global economy, and the US is still buying a lot. So I think, but this is something that businesses are going to incur greater costs and are really going to segment some of their supply chains. And I agree with Mark. I don't think, maybe I agree with Mark. I think that markets were expecting maybe too much stimulus out of China. I don't think that's going to happen because of the debt issues. And also because in some ways, like the US, maybe not as good as the US, but the economic conditions in China aren't awful. They're not great, but they're not awful. And the Chinese government's going to be focused on rolling over the debt, dealing with the issues, and really trying to look for the medium term, not to do some sort of short-term sugar rush that maybe people in the equity and oil markets were hoping for.
Well, they're certainly addicted to sugar rushes, given the amount of liquidity and monetary, the sort of QE of the last decade. The markets have become addicted to everything should be a sugar rush. Let's go to India, where we have Narendra Taneja, one of India's leading energy expert. Narendra, we come to you this week in which India now emerges as the top global oil importer of Russian crude, of course, enjoying that great discount. Your thoughts on the outlook for that, Narendra, at the moment, and given the price of Brent, it's around $75 a barrel, does the Russian crude remain as attractive given all the additional costs you have to pay for shipping and uncertain insurance and so forth?
You see, it's all about economics. As you know, that our demand is now back to the pre-COVID level. And in fact, it's growing. And at the same time, oil remains like the backbone of the Indian economy. Ours is an oil economy. So if we get good deals from Russia, we're buying from them. There's no love for any country or any geography, for that matter, Saudi Arabia, the United States, or Russia. It's just that the economics is working well. I mean, they're offering good discounts and they're helping us to ship that oil and insurance, provisions, etc. So that's why we're buying now. If you look at the kind of data very closely, Indian Oil, which is a state-owned company, has emerged now as the biggest importer, replacing Reliance, which is a private sector company, or for that matter, Nayara, which is actually
why is that?
Controlled by Russians. It's just that because they have been buying from other geographies, but they find the Russian economics is more attractive. They're offering better discounts, and also so far bulk of the oil has been coming from a spot market or spot buying, is vessel to vessel. And now Indian Oil has also entered into long-term contracts, which means that Russia has offered, a good deal in terms of long-term contract. There's still bulk of oil Indian Oil is buying is from spot, but then they have also entered into long-term contracts. That means that, India will continue to buy, oil from Russia as long as Russia is able to offer the good economics. Let's not forget one thing. That's one way to look at from Dubai or the US. But when we look at oil prices, I mean, if you go strictly by demand and supply, we see no reason for oil to be more than $60 per barrel. I mean, if purely going by demand supply and applying the economic fundamentals, why should oil be more than $60 per barrel? Is all premium.
Well, because
premium,
it costs on the
for,
average globally to invest in new supply capacity. The industry sort of standard narrative is you need $70 oil to attract the investment to build new supply.
Well, that's analysis from some quarters, which I respect. But at the same time, that's not the only analysis. You know, the point is there are other, for instance, that's true for some countries, especially if you are kind of, drilling or exploring in deep water, ultra deep water, or some difficult geographies. But there are many countries, for instance, where this thing will not apply. So when you take an overall average, and especially average from the country that India is buying oil from, we find that, $60 probably the good reason. That's probably, we don't know, but that's probably the reason that, G7, when they imposed the price cap, it was $60. So probably based on that analysis. So, but as he said, I can't speak on their behalf. But at the same time, $75 per barrel, we find that, that's kind of something that Indian economy can also live with. But at the same time, for us, the important thing is, since we are back on the recovery and we are, growing very, very fast, we want to grow even faster to 8, if possible, to 7%, to 7.5%. And this is also election year. General elections are approaching. They're there in 10 months. It's important for the government to make sure that the oil prices remain at a level, A, which is acceptable to the ordinary consumer, B, at the same time, boost growth, boost economy. So
well, you're not alone in that regard. With the US going into a presidential election next year, they also will want this oil price to come down.
Good for us. Good for us. That
Absolutely.
means India and the United States together, if they want oil prices, low, is good news. I mean, if an economy like
that's
the US,
why we're seeing, I think, easing of sanctions, or at least implementation of sanctions on Iran, and now some conversations with Venezuela. Let's go back to Mark in Europe and the UK. Mark, looking forward to the sort of Q3, the summer season, and the war circumstances in the Ukraine, what kind of a threat, or does it still present to the growth of Europe, to energy demand as we start to plan for next winter and the building up of gas inventories and so forth?
I think basically the picture of growth in Europe is very sluggish. It's a cumulative effect of all the inflation. It's also there's a big sort of contrast here. I was talking about stimulus we were expecting in China, which we'll see what it is. We have a lot of stimulus in the United States thanks to the Inflation Reduction Act. And in Europe, you've got the UK with austerity, a lot of inflation, high interest rates, and the EU, you have a lot of talk about doing things to attract chip manufacturing to Europe, to attract energy transition materials manufacturing, but nothing's actually being done. In fact, actually on pretty much anything, whether it's energy and power market reforms, whether it's reform of the Growth and Stability Pact, i.e. budget reform, there isn't any agreement on anything. So what you've got is a situation where they would, they want to do more to get their economies going, but they're not doing anything, hampered either by
what is the role of the cost of money impacting on that? I mean, taking back to the point that the raised in the FT op-ed today, but also just generally speaking, the price of money rising, and in Europe and the UK, it looks like they're still on an aggressive tightening path, whereas in the US, you might say they're coming to the end, but 50 basis points recently in the Bank of England, more to come, it would seem, given that elevated nature of inflation still in Europe and the UK.
The cost of money is no doubt a big problem for both. In the UK, I think the bigger problem is actually a lack of credibility about policy making, be that fiscal, be that monetary. In the euro area, it's a case of to be honest, actually, when you look at the level of interest rates in the Eurozone, they're not that prohibitive. They are historically quite high, but we're still only talking about a landing place for ECB rates of say 4 or perhaps 4.25. I think the latter is a little bit too high. In the UK, I actually think the market's pricing in 6.25% as an end rate. That is not actually representative of what markets expect. It represents the fact that the UK now attracts what used to be, for the older listeners and viewers, a risk premium. Because of bad policy making. It's akin to what it was in the 70s and 80s.
Well, we haven't quite recovered in the UK, I think, since that government that came in for a month back in November and nearly drove the bus off the cliff. Rachel, just coming back to the point made earlier regarding India's needs and going into the election cycle, and obviously the average oil price in India, when you consider more than 50% of their oil now is coming from discounted Russian, so they're probably averaging well below the Brent price, which is 75. In the US, as we go into the election cycle now, the noise is getting louder. Where's your thoughts on how that may impact strategy and policy around oil?
Yeah. So first thing to say, and I defer to Narendra on this, but when we think about the impact on the Indian fiscal balances on the Indian consumer, we also have to add in not just sort of the cost they're buying, but also the transport cost. And one of the trends that we've seen over the last year is the base price of oil is lower, but the transportation is higher. Part of that, I mean, maybe not quite as much for India, but for some countries. And that has been a dynamic of, with sanctions, with sort of new dynamics, intermediaries win. If you take a longer journey, if they're ship-to-ship transfers, so that element. But net, this is all sort of meaning that oil prices for India, for a big swaths of the global economy, are lower they'd be otherwise. And so that's good for consumers. It's good for deficit countries, of which the US, of course, is one. The US, of course, is a growing sort of energy producer. So look, I think that going into the election year, even, the US, of course, is having elections every 2 years, effectively, but going into the presidential election year, this sort of,
for example, the US government has a choice to the idea of refilling the strategic petroleum reserves, which is something that's been on the conversation for some months now. They have not done it.
They finally started to act on it, very slowly. And I think that's important, to act on the sort of the downside, right? To have said, if they're going to use it as a tool to the upside and downside, use it to both sides. So there were some technical issues, I think, for a while, and Ted's noting in the chat that they did add 3 million barrels. I think what was important, and I've been critical on this very podcast about times when the US didn't sort of step up to the plate here, because I think it added to the sort of tensions and different views between the US and Saudi Arabia on energy markets and balancing energy markets, when the US only was using the SPR on the upside and not to sort of send a message to the downside. But look, I mean, the Biden administration is going to want, on the margins, cheaper oil for US consumers. They'll frame it as wanting sort of beneficial for global consumers and the emerging world, but there is a domestic story here. And so I think it means you're going to see maybe this drip of a bit more sort of volumes out of Venezuela and maybe even Iran. I don't think we're going to see a big picture, maybe rapprochement with Venezuela. Of course, that depends a lot on what happens in their elections, which also are coming up next year. I guess often these elections coincide, but this
it's sort of like
keep it from being a crisis. Keep it from being some sort of false surprise as we head into the elections. I think that's going to be the goal. And, really just try to get in as much of this stimulus spending from the IRA, from the infrastructure, to both add jobs. But
you wonder also, whereas we're here gathered at the OPEC International Seminar, as we saw going into the last midterm elections, that the OPEC policy, OPEC plus policy, was seen by the Biden administration as being not appreciated in its timing. You wonder if that will have further standoffs over the next year as this obviously presidential election cycle becomes something much more consequential. Narendra, looking at India, of course, while the rest of the world is sort of crying wolf on recession, India continues to power ahead and is its economic growth patterns still seem very solid. Would we expect that to continue, as you say, going into the year of election stimulus and other policies to ensure the Indian economy continues on this upward trajectory?
Well, that's my sense. I mean, if you look at all the parameters, whether you look at, foreign direct investment to India, overall sentiments, and the, kind of infrastructure construction that you see across the country, wherever you go, across the country, you will see this, activity, new roads, new ports, new airports, and all this, the kind of buzz and enthusiasm, business enthusiasm. So I think it will continue. At the same time, India is following a very pragmatic policy. Only yesterday, India hosted SCO summit, Shanghai Cooperation Summit, and which is headquartered in Shanghai. And India, Russia, and China, and Iran became part of the SCO yesterday. So it's following very pragmatic policy. I mean, in the sense, whatever helps India.
What does
to grow
pragmatic
economically.
mean? Pragmatic means increasingly adopting an independent global position from the West as such. Is that what you mean by pragmatic, as sort of a standalone independent posture rather than what might be historically seen as aligned with the West? Now that India, pragmatic means independent and developing these new relationships with India or with China and Russia?
Well, you see, what does it mean? India is an independent and sovereign country. And in our way of
I know, but historically
world,
it's been independent since 1948, but it has always maintained a much more clear alignment with its Western democratic partners. You use the word pragmatic. I'm trying to translate that. What does that mean today?
Well, you see, the point is that India is a democracy. And when you look at, for instance, our, democratic values and all that, we are very, very close with the West, the United States, Western part, Western Europe, Japan, Australia, New Zealand, and all these countries. But at the same time, we maintain as part of our global strategy, since, we maintain very close ties with Russia, and we have very good working relations with China. I mean, whatever the world may think, but with China, for instance, for the first time in history, historic developments, and Indian oil has agreed to pay in yuan.
But you yourself, Narendra, have been a very strong commentator on not allowing Chinese hegemony in Asia and seeking the West not to be distracted by the war in Ukraine to neglect China's rise in Asia.
No. What I'm basically saying that as long as China is willing to this, that Asia can be a multipolar area, and they don't try to kind of work to emerge a kind of hegemon for the entire region, including Pacific, that's not acceptable to us. But if they behave in the sense they accept that all countries, Japan, Korea, Australia, India, they have the equal right to be a big power in this part of the world, then we have no problem. The problem is that, with Russia, our sense is that if Russia grows too weak economically and politically, it will slip into the grip of China. And then you get a greater China with border with Finland and with border with Western Europe and all that. Is that a good news? So what we basically is saying that Russia maintaining its strategic autonomy so that it can be independent, or they can deal with the Chinese with power and strength. That's good for the West. That's good for the world, and that's definitely good for us.
Interesting.
So
I take that point.
one line. What I'm saying is that India is home to 1.4 billion people. So therefore, you see the problem is the West. We are very close with the West. We have deep relationship, but they want us to be kind of their follower. We are too big, too independent, too ancient country, too smart to be follower of any country, any region, any power, including.
I don't know. I mean, I take your point. I'm not sure I would concur with the follower stature. Perhaps that's maybe some sense of India's perspective, but the optics of being, not just meeting with Putin, but also being incredibly chummy and laughing, and the whole posture and optics of the sort of brotherhood image that goes along with
no.
that's a different.
you have to allow me to react to it.
Yeah,
You
please.
see that's how you people look, when you look from the West. Why don't you object then, for instance, pictures of our Prime Minister having good time with President Biden in the White House, and laughing and joking
Well,
and
because
everything.
President Biden
So
isn't
Russia,
invading Ukraine and killing innocent children.
let me complete. Didn't America invade Iraq and kill Saddam Hussein, a sovereign country? Didn't do that? Let's not get into that discussion. Before that, just check Western countries' on track record. They colonized the whole world only 4 centuries ago. I just got back from Portugal after holidaying. Go to Portugal, it's home to only 10 million people. They colonized Goa and India for 500 years. So let's not get into it. You have no moral right to look at the world this way. We are a big country, ancient country, 7,000-year civilization. We have got our own worldview. We will choose who is going to be our friend, who we are going to laugh with, and all. That's our decision. If you don't like it, it's okay, but that you have to respect it. We respect
I know, but
you have
to also in choosing the moment, right? I mean, this is a particular moment in time where whatever history we're talking about today. I take your point. Let's move on to the survey question.
Don't ignore the history.
Yeah. History is with us all the time. I'm Irish, by the way, so we talk about history. We had the Brits on our necks for 800 years, but we move on. Let's go to the survey question. What will be the average price for Brent crude oil in the second half of 2023? Choose one. In the first half of this year is in the high 70s, I think about 79 on average. What will be the average price of Brent in the second half of the year, when we're meant to be in a year of two halves? The whole forecast for the second half of the year is the bumper return of demand. Let's do a quick closing comment from our three guests on their outlook for the summer months. Of course, we're going into a break soon on the Daily Energy Markets podcast, and we will be giving all of our great commentators a bit of a time to go away and go to places like Portugal and others to enjoy some time off. But Mark, your thoughts on what you'll be watching from the beaches as you take some time off over the summer, as we should keep an eye on for the direction of travel over July and August?
Well, I think the first thing is this divergence in performance between Europe, China, and the US. I still think the US is going to do a lot better. How we deal with how markets continue to defy what they're being told. Central banks have been telling them for more than a year, since the market started pricing in, next year we're going to, by the end of 2023, we're going to get rate cuts. Markets continue to create this fabulous story about we're going to get rate cuts. I'm concerned that this narrative is wrong.
I think that finally the rate cut thing is in the second half of the year is now out of the market. When we're still talking about rate hikes, we may even get a rate hike in the Fed in the coming weeks.
Yes, definitely. I mean, I still think the risk on rates is to the upside. The risk on the economy is, particularly the US, is probably to the upside of market expectations. And who knows, China may yet surprise us. That's not being optimistic. That's just basically saying they've been waiting a long time to deliver the stimulus package. Maybe it actually is going to have hands and feet in a way which we hadn't been expecting.
Rachel, your thoughts, what will you be thinking about as you're sipping Sauvignon Blanc in Tuscany over the summer?
Well, funnily, I'm just back from sipping Sauvignon Blanc and Pinotage in South Africa, so no comments about British winters in South African, or the reverse. All the things Mark mentioned, but I'd also throw in
Actually,
Russia.
that's just on that point. Yesterday,
Right.
hottest day of the year in history yesterday, just to bring that up as you're mentioning it. Please, your closing thoughts.
Oh yeah, no, exactly. So very much sort of watching what Russia does, on the supply side, right? In addition to all this important demand side issues that Mark noted, they've announced another set of cuts. Some of this, I guess, we'll hear more from the seminars sort of later in that context. But what's really happening? What signals are they seeing sort of on the demand side and the like? And then beyond oil, I'm really watching what happens with refilling gas storage and especially the natural gas issues around, are we going to see Europe wake up and say, you know what, we need to sign more long-term contracts? That's probably not going to be this summer. That's probably more a long-term issue. But I do think that just as there's been, sort of demand weakness, there's a certain amount of complacency about the sort of energy shock being over in Europe that, I think we're going to be talking about for some time. And just watching these dynamics of a whole set of countries that are trying to act in their national interest, balance in this multipolar world, and what that's going to mean for businesses. There are opportunities for some with friendshoring, and there's additional costs for others.
Narendra, Taneja, the last word with you today on your thoughts and outlook for the summer and what you'll be watching over July and August.
Well, you see two things. First is, of course, how economies go in this part of the world, most particularly the United States, and including, of course, the kind of how Fed is looking at interest rates and so on and so forth. But my sense is that with US kind of now getting into the election mode, India getting into the election mode, I think, other powers are going to basically cooperate and coordinate and make sure that the overall sentiment with regard to energy prices remain within the manageable boundaries and limits. That's my sense. And by the way, India and the United States, they cooperate a lot when it comes to the oil prices. Second, my sense is that, demand and supply very important in terms of the prices, but at the same time, the fact remains that geopolitics has not gone away. And I think Ukraine is still a very important issue. We don't know what happens. And at the same time, the relations with regard to United States and China, that is still a dark zone. We don't really know what happens. So we have to keep our eyes open. But my sense is all prices coming over 2-3 months are going to stay in the region of $70 to $80 per barrel. They may drop below 70 for some time. I'm talking Brent may go up, beyond $80 per barrel. But I think the average, my sense, is going to stay in the region of 70 to 80. And that remains a kind of price which, for instance, big importers like India or China would not be complaining too much about. And big exporter like Saudi Arabia probably can also manage the economy well as far as the prices are in this region.
Well, thank you so much. I think here this morning, we're going to get some indication with an interview on the stage behind me with the Saudi oil minister in an hour from now. And how aggressive or will we hear their determination to, as they would say it, keep the market balanced by withdrawing more crude oil in the second half of the year as the natural annual cycle tightens going into next winter? Will OPEC Plus continue to be aggressively cutting supply? That may be a big factor to determine where the average oil price in the second half of the year will be, with the counterweight being, of course, greater interest rate hikes in the G7 and the tightening of economic conditions there. But we'll leave it at that. Thank you so much, Narendra, Taneja, for being with us this morning from India, Rachel Ziemba, and of course, Mark with us from London. Have a great summer, you guys. Really appreciate your time, and we look forward to seeing you all back in September. Obviously, the daily energy markets continues for another 2 weeks, but each of our commentators, this will be their last innings till September. So thank you, guys. Halftime talk interview coming up shortly. Please look into that. All the best and greetings here from Vienna, where we'll be reporting later in the day on any notable comments made. Thank you, guys. All the best.
Bye.
Thanks, Sean.
Bye.
Thanks. Bye.